So Foot Locker just released their earnings today and they did extremely well. I'm going to load this up in the software here. I'm going to talk about Foot Locker. We're going to go run through the numbers of this company and then finally find out what the intrinsic value of this business is to figure out what we should be paying for it today. It is obviously on a little bit of a stock price increase because obviously earnings came out very positively. So currently at the time of recording this video, it's trading at a price of $35.51. So let's go dive deep into what Foot Locker is all about. I'm ranking this company a 7 out of 10. Now you're wondering, if you're new to the channel, what does that number mean? So this section of the software grades the company's financial statements, so their cash flow statements, balance sheets, and income statements, and gives it a grade if it's hitting certain criteria. 7 out of 10 is actually a pretty decent score. And what Foot Locker is doing right is a lot. What they aren't doing right is a few things here. And a few of those things are not terrible. Actually, they are pretty bad if you put them in consideration. One of those things is the debt to equity ratio. It's 86%, folks, where we want to see companies that have a 50% or lower debt to equity. That just means that they're using financial leverage within their equity and not taking on so much debt. And as we approach a recession, this has been the ongoing point with a lot of the companies I've been looking at, is we want to find companies that have a low debt to equity ratio, because if the times are uncertain economically, we want to make sure we have a little bit of a buffer in place of that. And I apologize if you hear any extra noise in the background. We're just doing some renovations here, so any sawing or cutting, that's just next door. Now, our current ratio is sitting at 1.46. This is actually not terrible. We want to find companies with a 1.5 current ratio or higher. Now, that indicates to us that they have enough assets on hand to cover those liabilities that they might have in the future, and how liquid the company actually is. 1.46, I can actually forgive that. It's actually not that bad. That 1.5 just gives us a little bit more of a buffer. 0.46 is easily forgivable. The one major issue that I have here is the free cash flow growth. That's in the negatives. Negative 15% in free cash flow growth over the last 5 years. That is not healthy, folks. We want to see the increase in free cash flow. That is the life of the company. So seeing this is not looking too great. So if it's decreasing, that could mean a lot of other things. People are shopping elsewhere. People are not going in stores, which makes no sense to me, because I feel like the only way to actually buy shoes is to actually go into a brick and mortar store. Those are the three things that Foot Locker isn't doing correct. But what are they doing right? A lot of things. They have a low PE ratio, 11.62. That means you're not paying through the nose in terms of a premium on this company. We want to find companies underneath 22.5, and they're definitely there. The share dilution, they are buying back shares, so which is great. We want to find companies that are buying back shares and not increasing the amount of shares outstanding. Their return on invested capital is high. The net income has been going up, as well as the revenue growth is up. Even though it's a marginal increase, only 3% over the last 5 years, it is an increase nonetheless. As well as their EPS has gone up as well. And if you compare that, if you compare that with the company metrics, now this takes the 5-year averages of what the company's been doing, and you can see how it compares to the trailing 12 months. Even with the lower price to earnings ratio, you can see that the EPS is higher than the 5-year average. Our ROE is taking a little bit of a step down compared to our 5-year average, but the profit margins are pretty much almost the same. The main kicker is this free cash flow, which I'm not liking. The $600 million average is great. However, a free cash flow right now is negative 11.6 million. So not healthy there. But everything else is pretty much on par. Almond Z-score could be a little bit better. 2.47 is not the greatest score. We want to find companies that have a higher Almond Z-score, a 3 or higher. And P.A. Atrocity score sitting at 4 isn't the best. Foot Locker is one of those brands that I don't see going away in the near future. They are pretty much the top, I guess, the hub if you want to get anything athletic. Obviously, there's other competing stores, but if you have to get something from Nike, Adidas, Puma, Converse, anything you can think of, that's a go-to store. If I have to go buy shoes, this is the first store I think of if I have to go pick something up. So folks, in order to obtain the intrinsic value of Foot Locker, I'm going to input some numbers here in the price analysis section, doing a 10-year evaluation, conservative, moderate, and aggressive. Now these are just 3 different assumptions I could put in. I could do either 1 or 2 or 3. 3 probably works best. I'm going to utilize the numbers that they've shown in the historic averages, so 1, 5, and 10 years. and then we'll figure out what we should be paying for this company today. So stand by while I input these numbers. Folks, if you're enjoying this video so far, hit that like button and the subscribe button. This software that I'm using, it's a mobile app. We're developing into a mobile app rather. Right now it's currently in this desktop form, but if you want to get your hands on it, try it out for free, absolutely free. 7-day free trial, follow the links in the description box below. With our revenue growth numbers, and here's the thing folks, I try to stay as conservative as possible because I can't assume that this company is going to be growing quick. And I see a lot of green numbers here, that's actually really good. The only thing is folks, I don't know how fast they can actually grow in the future, so hence why my revenue growth numbers are low as it is. Profit margin and everything stays the same. Compared to what our 10-year numbers are. Price of free cash flow, I try to stay as moderate as possible. Desired return is 13%, along with a PE ratio that I think the company is going to be at in the next 10 years. And take a look at that. With my conservative estimates, it's coming out to be $77.63. Current price is $35.29. So what does that indicate to us, folks? That with these conservative numbers, I mean, here's what I want to do. Now I want to try to find what is the lowest amount I could possibly pay for this company, and assuming the lowest possible revenue growth numbers. I'm going to click calculate once again. That's 1% revenue growth over the next 10 years. That is literally nothing. Wow. I go 0.5, I go 1.5. So it's pretty much, to me folks, that Foot Locker at the time of recording this video is pretty much a screaming value. Look at that. Let's say if I'm assuming 0.5% revenue growth over the next 10 years, that is nothing. Profit margin, it has to be able to hit these consistent numbers here, 6 and 6.70, and 1 year hit 9, so that's why I did 6, 6.5, and 7. I think I'm pretty fair with these numbers, and it's currently trading half, pretty much undervalued from its fair value being at $56. So folks, what does that mean? Well, this opens up the gate to a lot more research into Foot Locker. I am not a sneakerhead at all. So if you are in the midst of researching this company, using the numbers that I've provided, this screams from a numeric side, it is undervalued. However, this is a start to a larger, deeper research process. Now, my app provides the latest news and financial statements, as well as like if you want to see everything visually, just go to the charts section here and we can see what's going on really with this company. Yeah, so 2020 and 2021 they got hit. Share dilution is obviously, it's down. Total assets have been, liabilities have creeped up a little bit, but assets have been climbing up higher. And overall, I mean, it's been pretty much following SPY a little bit, beating the market in some areas. What are my thoughts on Foot Locker? I think the numbers make sense. However, like I said, we have to dive deeper. Brick and mortar stores are kind of in this weird transitionary period, I think, where we might not see them phase out. But I think with a store like this, you have to try on shoes, you have to try on clothes. This makes the most amount of sense for this to continue on in a brick and mortar store, and I think they can be able to capitalize on the e-commerce side as well. And with the brand recognition, they have a lot going for them. Now, they crushed earnings, and it's evident that they are doing well. They are pretty healthy as a company. However, the one thing that is a major flag to me is their debt to equity ratio, as well as their declining free cash flow, which involves a lot more deeper investigation. Now folks, that's the video. If you want to see a company analyzed, write it down in the comment section below. I will see you in the next one. Thank you so much for watching.